The world's most successful investors have amassed fortunes as a result of their efforts. And in many cases, they've assisted millions of others in achieving similar results. However, few investors can match Peter Lynch's track record. Peter Lynch ran the Fidelity Magellan Fund between 1977 and 1990. During that time, he outperformed the markets by a large margin. He averaged over 29% yearly returns and outperformed the S&P 500 11 times out of the 13 years. During his time as the manager, the Magellan Fund outperformed 99% of all mutual funds. He grew the Magellan Fund from $20 million in assets to $13 billion in that short period, making it the largest mutual fund in the United States. A $1,000 investment on the day Lynch took over Magellan Fund would have been worth $28,000 when he left. His ability to run such a large fund, while consistently delivering fantastic returns, has elevated him to the status of one of the most admired and revered investors. Peter Lynch retired from Fidelity in 1990, at the age of 46. In this rare masterclass, Peter Lynch himself teaches everything you need to know to be a successful investor.
The first point is know what you own. I can't believe how many people own stocks and they couldn't describe to an 11-year-old in 2 minutes or less why they own this thing or what it is. If you actually pin them down and you put a whip to them, they'd say the sucker's going up. That's the only reason they have. I mean, I buy stuff like Dunkin' Donuts and Stop and Shop and CVS and I'm talking sophisticated people, unsophisticated people. They don't know what the company is, what's the story. And it's very important to know it because it doesn't always work and you have to keep posted. Now here's a big point. Remember this one. It's futile to predict the economy, interest rates, and stock market. I mean, people keep trying to do this. I mean, this would be useful. I would love to know when we're going to have a recession. I'd love to know when interest rates are going to go up or down. I'd love to know when the stock market's going up. That would be helpful. I would like to get next year's Wall Street Journal. Unfortunately, you don't get it. I remember in 1982, we had a lot of people in this room around for 82. We had 20% prime rate, 15% long governments, double-digit unemployment, double-digit inflation. I don't remember anybody telling me about that in 1980. I don't remember anybody telling me about that in 1981. But in 83, I remember they said, well, the economy's bounced back. We're going to have a recession in 85. In 85, they said we have a recession in 86. In 87, something happened in October 87. I forget what something happened in October 87. Celtics lost 7 in a row. Something bad in 87. They said for sure we'll have a recession in 88. And they said 89 for sure we'll have a recession. And then 90, we're supposed to have the so-called soft landing, which we never had. So I've always said if you spend 13 minutes a year on economics, you've wasted 10 minutes. And all you need to know about the stock market is it goes up and it goes down, and it goes down a lot. And that's all you need to know. Again, it'd be terrific to know what's going to happen in the economy, but I deal with facts. If inventories are going up, if copper prices are going down, if room occupancy is going the wrong way, if people are building too many hotels, I look at freight car loadings when I own railroad stocks. I deal with facts. I don't deal with people tell me something's going to happen in the future. You might as well call the psychic hotline for that stuff. To get a better average. You got plenty of time. This is true of Sally Mae, it's true of Dunkin' Donuts, it's true of Stop and Shop. People are so insistent, I'm that way too. I have to fight it. They have to buy a stock, let's see, it's now 501. I haven't found a stock yet today. I got to find a stock before sunset. You could buy Walmart 10 years after Walmart went public. Let's say you're a very careful investor. You waited. You said, I don't know if this company can make it. You waited for Walmart to roll it out. You could buy Walmart 10 years after they went public and made 30 times your money. 30 times your money. 10 years after they went public, they're only in 15% of the United States. 1.5. They hadn't saturated the 1.5. You could say, well, why can't they go to 17? Why can't they go to 19? I mean, why don't I take a leap of faith here? Why can't they go to 26? All they did for the next 3 decades was roll it out. You could buy Walmart. If the day they went public, you bought it, you would have made 500 times your money. If you waited 10 years in Walmart, you made 30 times your money. You got plenty of time in this business. If it's gone down this much already, it can't go any lower. I remember when Polaroid went from 140 to about 107. And people said, if you ever get Polaroid under 100, you got to buy it. You just back up the truck, buy the stock. Stock, you get to 110, then rally, fall 103, you go 112, go 105. They said, gets under 100, buy Polaroid. Polaroid broke 100. People started buying it, and within 9 months, the stock was 18. I saw the same thing with Avon Products. So just saying, it's gone down this far, how much lower? I mean, it's crazy, but, it can keep going. In fact, I tried this out. Kaiser Industries, I was a new analyst at Fidelity, and we were about to buy the biggest block ever at Kaiser Industries. The stock had gone from 29 to 17. We're about to buy the largest block ever in the history of the American Stock Exchange. We bought, 10 or 15 million shares. At 15.75, I said, my God, the stock's gone from 29 to 17. How much lower can it go? So we bought this enormous block at 15.75. So I called my mother and I said, Mom, I guess stock at Kaiser Industries, it's 10. So about 3 months later, I said, you ought to buy this. It's gone from 29 to 10. How much lower can it go? Well, it went to 9, it went to 8, it went to 7, it went to 6, it went to 5, it went to 4. Now, fortunately for me, this happened very rapidly, or I'd be working at the Stop and Shop bag and behind the lines instead of Fidelity. So fortunately, this was compressed in only about 6 months. So I had to go to the fund manager and say, I was a little bit early on this at 15.75, we call this premature in the business. Had a correction, which is a euphemism for losing a lot of money rapidly. So I said, let's check this again. The stock's 4. They own 45% of Kaiser Aluminum. They own 59% of Kaiser Steel. They own 38% of Kaiser Cement. They own all of Kaiser Electronics, all of Kaiser Broadcasting, which had 7 TV sets. They own Jeep. They had Kaiser Fiberglass. I said about Kaiser Sand and Gravel. They had a bunch of other Kaisers, and they had no debt. Now, in this room, because I know Freeman Billings is very interested in financial stocks, no one's ever gone bankrupt without any debt. Now, that would take I think you have to give some kind of distinguished service award to somebody who did that. But they had no debt, and I said, it's not going to go to 0. I was wrong when I said it can't go below 15. So we hung on, and within 3 years, they gave out the shares in Kaiser Steel, gave out the shares in Kaiser Cement, gave out the shares in Kaiser Steel and Aluminum, and they sold off all the businesses. You got about $55 a share. But if you didn't know the story, and the stock went from 15 to 11, and you're just saying, how much lower can it go? When it went to 9, went to 8, you would have gone. So you can't just say it can't go any lower, because I saw Taco Bell go from 14 to 1 in 1974, and they had no debt and making 60 cents a share. Eventually, they always come back. Here's another one that sucks. That's a technical stock market term we just use only in the stock market. The RCA just about got back to its 1929 price when it was backed out by GE. Manville never came back. International Harvester, even with its name changed and adjusted for splits, hasn't got all the way back yet. Western Union, double knits, remember those wonderful things? Floppy disks. They don't have to come back. But they say eventually they always come back. Not true. Here's a great one. It's $3. How much can I lose? This is a great one. Because get out. I don't have a computer and I can't do high-level math, but just do this one. So let's say your neighbor buys $10,000 of a stock at 50, and the stock's now 3, and you put $25,000 in at 3. If it goes to 0, who loses the most? A lot of people cannot answer this question. If you put $1 billion in at 3, you can lose $1 billion. They blow taps in lots of companies every year. They can go to 0. This is a very important rule. It's one of the key rules. The stock doesn't know you own it. Remember that. You could be a miserable person. You could have, never helped anybody, never done anything right, had 67 spouses, never done anything right. If you own Coca-Cola the last 50 years, it's gone up 300-fold. You could be the greatest human in the world, help Special Olympics, help the mentally challenged, help poor people, help AIDS people. If you own Bethlehem Steel, it's lower than it was 30 years ago. It's not your fault. Don't take this personal, But people treat stocks sometimes like a grandchildren or a puppy. They think the stock knows who you are. It doesn't work that way. I don't have to worry. I own conservative stocks. I remember when Con Ed fell 80%, then tripled. Public Service Indiana went down 90%. Gulf States Utilities, Long Island Lighting. This may be an oxymoron. We had Quality Texas Banks that went to zero. We had Quality New England Banks that went to zero. These were companies that have been around for 150 years, 120 years. Saying I own conservative stocks, I don't have to worry. I've seen a lot of people that inherit a stock from somebody. They'll say, you know, my mother said on her deathbed, don't sell the Long Island Lighting. You know, you always wondered, you know, she's going to heaven, or hopefully where she's going to heaven. You know, they talk about a Little League game or a vacation or a game of hearts they had, or imagine talking on your deathbed about Long Island Lighting. And you say, well, you know, but you get these stories all the time. And I think your mother would have noticed, she wouldn't have sold at 29, but she would have noticed they had this little plant that was about $6 billion over budget. No one wanted it and wasn't working, and Long Island stopped growing. So maybe she would have turfed it at 22 or got out at 18. She would have let it go to 4. You know, so just because you inherit some stock and it's so-called conservative, like Eastman Kodak fell 75%, IBM fell 75%, don't tell anybody you own a conservative stock. Companies are very dynamic. I don't buy that argument. Stock has gone up, I must be right. Stock has gone down, I must be wrong. I'm convinced that people do this all the time. They buy stock at 10, they buy a little bit of it, it goes to 13, they now say, they don't know anything more about it than they knew when they bought it at 10. They have no idea what this company does. It's gone to 13 now, they take a second mortgage in their house and buy it at 13. The best thing that can happen for us is the stock go directly from 10 to 4 for these folks. Yeah. It's going to go to 4 eventually, but it goes to 13 in the middle. They're convinced now, they bought 100 shares at 10, now they buy 20,000 at 13. And all the fact is the stock went from 10 to 13 is that it went up. The average movement of a stock on the New York Stock Exchange this century, between its high and its low, has been 50%. The average stock in the New York Stock Exchange. That means the stock started the year 20, sometime during the year sold 16, sometime during the year sold at 24, might have finished the year 21, might have finished the year 19. The average range of a stock on the New York Stock Exchange is 50% in 12 months, between its high and its low. So stocks go up and down a lot within a year. And say this stock is going up means you're right, doesn't mean a damn thing. So don't buy off on that one. That is not a good one. Avoid long shots. These are the companies that, we have this very technical term for this called whisper stocks. Everybody familiar with whisper stocks? They're great. Somebody call you up and they'll say, hi Pierre, how's Carolyn's, how's Beth doing, how's Annie, how's Mary, have you played any golf? And then they'll say, I want to talk to you about international blivet. And these are always these long shots. You know, these are the stocks that are going to grow hair and make your kid have better spelling, and your breasts can improve, and you won't have to iron your pants. You know, it's one of those stocks, and they always do everything for you. But they're missing, they don't have any sales yet. You know, that's the missing element to the story. The story is sensational. There's no profits here, no sales yet, but my God, if this works, it's going to be the next Xerox, you know, and it's going to help Murr in space and everything. It's a very, very good deal. Now, this is not a long shot. This is a no shot. You have to separate these out. I've tried 30 of these. I have never broken even on a long shot. Never. I've made 25, 30 times my money on some stocks. I never thought about Sallie Mae or MBIA or Fannie Mae or some of the banks or Stop and Shop. I'd make 20 times the money, 30 times the money. I had no idea. I thought the stocks were going north. I had no idea. You look back 10 years later, you say, my God, I made a lot of money in this thing. But once I went into thinking I could make 4 times my money, I've never broken even. So don't do the long shot, guys. They don't work. They simply don't work. And again, if a stock's 3 and it has huge potential, write down the story, take the stock symbol. If it's going to 300, it's okay to buy it at 15. Check in later. Check a year later. See if it's still listed. See if it still get a quote on it. See if they still have earnings yet. But if it's going, write the story down. Some of these work. I haven't heard yet, but maybe they will work. But it's worth tuning in 6 months later. Don't buy it then. Importance of management. Management is the single most important thing in a company. But for an outsider to know great management versus good management versus terrific management versus average management, tough to do. Tough to do. Because you only get an hour at people, sometimes a half an hour. And how do you know what decisions they didn't make? A lot of great companies have been made because the company didn't make an acquisition. They didn't get rid of the division. They don't put in the annual report, we didn't get rid of the tubing division. You know, you don't hear about that. Somebody said, made a brilliant decision, we're going to hold on to that thing, we're going to fix it, and it's doing great. Now, they might be doing great because some management 8 years ago did it right, or some did something right 5 years ago. That person isn't there anymore. Or they didn't make any acquisitions, or they expanded at the right time. So knowing what management, what they can add to it, it's the single most important thing, very hard to measure. I've always said, I'd like to have a company any fool can run, because eventually one will. And you really want to do that. When I bought Toys R Us, they had the formula right. Any 4 people in this room and me could have run Toys R Us. We wouldn't have done as well as they did. They're spectacular. But for the next 15 years, we had no competition, we had a great formula, we could have rolled with it. They probably would have done 3 times as good. They were the frosting on the cake. But they had the formula right, no competition, the department stores know what they're doing, there's no copycats, and they were going to just roll for the next 25 years. Same with Circuit City. So I want the story to be solid. If management can add anything on top of it, that's great. I want to buy the story. Assume management leaves the next day, and they're replaced by the next generation. That's fine with me. If management can add something to it, that's great. I'm not going to buy it because people say they have great management. Because you'll notice great management is always attached to stock's been up the last 8 years. You ever notice that? Because I looked at Reynolds Metals. I used to follow Reynolds Metals. The stock has had the same person run it for like 30 years. When the aluminum was tight, they'd say Reynolds Metals has great management. Aluminum going oversupplies, these people are idiots. When aluminum get tight, they say these people are terrific. I mean, it all to do with the price of aluminum. And they keep rating the management by how the stock's doing. It's very hard to measure management. It'd be wonderful to do. If you could spend months with them, really see them in action, then you'd know, but you don't really get that chance. Now we'll get to the important stuff. There's always something to worry about. This is the difference. This is what happens in the stock market. Because, see, everybody's got the brain power to do well in the stock market. The question is whether you have the stomach for it. That's the key organ in the body. There's always something to worry about. I went to school, grew up with a kid in the 50s. In the decade of the 50s, there's this big theory that the Depression was caused by a stock market crash. Totally wrong. Less than 1% of Americans owned stocks in '29. We had this big time recession. In fact, it was a depression. It wasn't caused by the stock market. The economy went down, the Federal Reserve raised interest rates, and we had a big time depression. In fact, we had several depressions like that from 1850 on. This was only one of about 8 depressions since 1850. But people thought the only reason we got out of the depression was World War II, and they said once we get back, next time we have a recession, we're going to have a depression. And it's going to be a great depression. I never understood that adjective in front of depression. It ought to be crummy depression or bad depression, but it was a great depression. I never quite understood that one. So people weren't buying stocks in the 50s because they thought that another great depression was going to happen. In addition, people were very scared about nuclear warheads and nuclear war in the 50s. People were building fallout shelters, stocking canned goods. There's something about going to Vermont, building a fallout shelter, putting canned goods in it, that you don't buy Minnesota Mining or you don't buy Eastman Kodak. I mean, the syllogism just doesn't work out that you're buying lots of water, buying a shotgun, buying frozen food that will stay in the freezer with your own generator, and you're looking at growth stocks. Doesn't seem to work out that way, you know. And I remember in the 50s, I remember literally in classes, I was in elementary school in the 50s, and they'd come in, they'd have one of these air raid drills. Somebody with a yellow hat would come in, they'd blow a whistle, and you'd get under your desk. Even then I says, I don't think this is going to do a lot of good, you know. But people were worried about a depression and nuclear war in the 50s. And then, the warheads, they couldn't do much damage back in the 50s. Now one of these Stan countries, you know these Kakistan and Kazakhstan, all these Stan guys that have spun off these Friedman building spin-offs from the Soviet Union, they didn't lead it. There was a co-deal with somebody else, Goldman Sachs, and they were on the left side, though. Every one of these little countries has enough warheads to blow the world up 88 times. Who's built a fallout shelter lately? You know, we stopped worrying about it. There's always something to worry about. In the 50s, it was depression and nuclear war. The 50s was the best decade of this century for the stock market, except for the 80s. Only slightly better. The 80s are only slightly better. People didn't expect a lot. We had it wasn't a great decade. They just didn't expect much. We made it through. And the stock market was terrific. you remember when oil went from 4 to 40? Remember that period? Oil went from 4 to 40, and the experts said it was going to go to 100, and all the countries of the world were going to go bankrupt. And then the big banks are going to go bankrupt, and we're going to have a Great Depression, and the stock market's going to go down, and you're going to wind up selling pencils and apples. Well, I remember when oil went from 4 to 40, and the experts said it was going to go to 100. Within 2 years, oil was at 14. The experts, now much higher paid at this point, are saying it's going to go to 4, and we're going to have a depression. And people believed it again. I remember when the money supply was growing too fast, and they said we're going to have a depression. Then it was growing too slow, we're going to have a depression. Then the Mideast was going in the world. Remember that one? The Mideast was going in the world. They weren't going to buy our bonds, and the market crashed, and we're going to have a depression. Then Japan was going in the world. Remember that one? Japan was going to have all the assets, and they weren't going to buy our bonds, and we're going to have a depression. Within 3 years, the Nikkei Dow had gone from 40,000 to 16,000. The banking system was in trouble, and people said Japan was going to collapse, and we're going to have a depression. I mean, people had, on their prayer list, at the end of the day, they had eliminated crippled children and Mother Teresa, and they're praying for Japan. I mean, it's a country with a 15% savings rate, it's something bizarre, Commercial real estate, global warming, And I think as the older you get, the more nervous you get about these things. I think it's very valuable. I think while younger people are better investors is they're not worried. They haven't heard about all these crises. And they're with children. I think if you don't have any kids, you got to rent some kids for the weekend. Get a 7-year-old and ask him if he knows about the money supply, how fast it's growing. Ask him if he knows about the shape of the yield curve is the wrong shape of the yield curve. Or that we're 48.3 months into the economic recovery and the average recovery lasts 52.3 months. Ask an 8-year-old if they know about that. 8-year-olds have a very high expectation about the next 20 years. That's what you need to do. The more you get away from 8-year-olds, the more you get away from 11-year-olds, the more you start reading these crazy things you read over the weekend. In fact, from 1955 to 1985, the stock market went up a grand total of 1,000 points, but it was down 800 on Mondays. So it was therefore up 1,800 on non-Mondays. It wasn't an accident. The stock market went down October the 19th, 87 was a Monday. People over the weekend become economists and portfolio strategists. I mean, they're a bull if they take their lunch on the way to work. In fact, I knew very well the market was going to go down in October of 87. Dave Elson remembers it. It was my first vacation I was going to take in 6 years. And we decided to go to Ireland, and we stayed at all these little cottages and play golf. And I left on Thursday after the close of trade. The market was down 55 points, which wasn't a good start, but it was down 55 points. And we got over there, and because of the time zone, we were able to do what we wanted to do and get down to Cork, and called in. The market was down about 118. And I said to Carolyn, if the market goes down on Monday, we better go back. But we're already here, so I'll just stay for the weekend. So as you know, the market went down 508 on Monday, so I flew home. Because my fund had gone, I think, from 13 billion to 9 billion in 2 working days, and it was the trend here is not positive. Like I could do something about it, But there's something when they called, they wanted to say, well, what's Lynch doing right now? Well, he's on the 10th hole. He's even par on the front 9, but he's in a trap right now. This could be a double bogey. This could be a quadruple bogey right here. Could blow the entire front 9 right here. This is not what they wanted to hear. So I have no idea when the market's going to go down, and no idea when it's going to go up. I'm totally shocked. The market was 4,000 2.5 years ago. A while ago, it's 8,000. I had no idea about this. Very surprising to me. But I'll guarantee you the market will be a lot higher in 15 years. It'll be a lot higher in 25 years. What it's going to do in the next 1 or 2 years, I don't have any idea. And if somebody in this room knows about it, they're not telling anybody. Or they're not in this room. They're down in Palm Springs somewhere. They've made $1 billion. Or if they know anything about interest rates. Because in interest rates, if you can be right 5 times in a row in 10 grand, you can have $2 billion. There's not that many people with $2 billion. There's a lot of people predicting interest rates. Did you ever think about that one? Just 5 times right in a row in 10 grand, $2 billion. If you write 7 times in a row, you can have the GNP of the United Kingdom. It's a big number. So I don't worry about that. I know we've had 96 years of century, and the market's fallen 53 times. We've had 53 declines of 10% or more. So 53 declines in 96 years. Once every 2 years, we have a 10% decline. Of the 53 declines, 15 have been 25% more. So 15 in 96 years, about once every 6 years, the market falls 25% more. That's what we call a bear market, you know that. And it's going to happen. I don't care when it's going to happen. I would love to know. Obviously, it would be very useful to know when it's going to happen. It doesn't make a difference to me. Corporate profits will be a lot higher 8 years from now, a lot higher 16 years from now, a lot higher 30 years from now. That's what I deal with. When do you sell stocks? When you sell a stock is exactly the reason you buy it. You write down the reason you bought it. I bought Subaru. Subaru was a distributor. They didn't actually make the cars. I think it was Fuji Heavy Industries made the cars. They distributed Subarus in the United States. The stock was, I think the stock was 80. It was up from 6 to 80. I was a little late on this, but it didn't bother me, and I should never let that bother you. I didn't let it bother me. They had $40 a share in cash. They had a very low-priced car. It was well-liked. And it did well for about 5 or 6 years, and I think the stock went from 80 to 320. The reason I sold Subaru, thank you. The reason I sold Subaru is Hyundai came in with a low-cost car. Chrysler cut the price of the Omni Horizon. Ford came out with a low-priced car at the end. All of a sudden, the Subaru was no longer unique. If the car's not a buy, the stock's not a buy. That's what you're looking for. The reason you buy a stock, you keep it posted. If the reason changes, you go on to something else.
We believe everyone deserves to have a financial education. Here at Investing Unlocked, our mission is to help educate one person at a time and empower people with the knowledge and tools to make better financial decisions. If you want to get smarter about investing and want to be part of our community, please press the like and subscribe buttons. Good investing. And I will see you next time.